Stand by for the CryptoSavvy podcast. The CryptoSavvy podcast is intended for educational purposes only. As with all things, do your own research, and let's get right into it. Hey, this is James. Thanks for joining me for this episode of the CryptoSavvy podcast. Today we are going to hit everyone's favorite subject, Cryptonomics. Oh yeah, that's right. It's one of my favorite subjects too, because it gives us insights into the crypto markets and how we can best plan, plot, and invest. But before we get into that, let's talk for a second about two news items that were in the headlines this past week. One, Capital One is looking at spinning up a cryptocurrency division. The second, Goldman Sachs this past week released a report indicating strong support for the Ethereum network and the decentralized finance tokens and applications being built thereon. That is a potentially really big deal in that it could signal institutional adoption by these brick and mortar institutions. We'll have to keep an eye on it. So before we get into Cryptonomics, let's take a second and talk about DeFi real quick. Decentralized finance is an umbrella term for financial services on a public blockchain. In this case, we're talking primarily Ethereum. With DeFi, you can do most of the same things that you do with a bank: earn interest, borrow, lend, trade derivatives, trade assets, but it's faster and doesn't require a third-party authorization. And as with crypto in general, DeFi is a global peer-to-peer system that is pseudonymous and open to all. Let's look at why DeFi is important. DeFi basically takes the premise of digital money and really expands on it by creating an entire digital alternative to Wall Street without all of the associated costs of those brick and mortar institutions. And that has the potential to create a more open, free, and fair financial market that is accessible really to anyone with an internet connection. Again, what are the benefits to this? It's an open system. You just access it by having a crypto wallet. It is a pseudonymous system. You don't need to provide your name, email address, or any other personal identifier. It is flexible in that you are in control of your assets at any time, can trade, buy, sell without anyone else's permission. And they're fast. Crypto transactions are a small percentage, almost fractional, in the amount of time that it takes to complete a transaction, often in as quickly as 15 to 20 seconds, even with a busy network. So all of this is transparent. That's one of the key benefits of this peer-to-peer system, in that we all provide our consensus and trust to use. It's transparent. Even though our identity is not tracked to our transactions, all of our transactions and all of everyone's transactions are completely visible for the world to see. That's a big deal. It's a change in the paradigm, and I like it. But stock markets. Let's touch on these things kind of quickly, and then we'll talk in more detail in episode 4. What's a share? A share is basically a unit of ownership in a company. Represents a claim on the company's assets, either in liquid funds, in money, or in their physical property. And investors, you buy a share hoping that you're going to have a increase in either the price of the share or a return in the form of a dividend when the company is profitable. There are three kinds of securities, stocks being one of them. Bonds are another, which represents a creditor relationship. It's actually a debt instrument representing a creditor relationship with either the governmental body that issues it, like the US government, or a corporation. The last is derivatives, which are financial instruments deriving value from an underlying asset, kind of like the name implies, huh? In the United States, stock markets are tightly regulated by the SEC, the Security and Exchange Commission. If we map a stock to a token, some of the comparison and contrast, and this is tokenomics 101, just the basics. A share represents ownership in the company and gives the owner rights, like voting or earning dividends. Tokens don't represent ownership of any kind. Shares cannot be used for procuring products. Tokens are used for that. They are a currency. Shares generally are a way for a company to raise capital, and tokens are intended generally to be used as payment within the project's ecosystem. Stock markets, tightly regulated by the SEC. Crypto markets, regulation surrounding this is largely in a gray area in most jurisdictions, and we'll see what develops. Another interesting thing that is happening is tokenization. Here we're talking about NFTs, non-fungible tokens, where a token is being assigned as a representation of a tangible asset. What we mean by that is a token is created to represent a piece of artwork or a song or perhaps a piece of real estate or a vehicle, a car, a boat, a plane. We see tokenization in equity in the crypto market in and of itself because we are trading fiat currency, US dollars, for a token. We're buying a token, and that is tokenization of our US funds. Interesting stuff. So let's do a quick wrap up. Stock markets versus crypto markets. In a stock market, the value is based on the idea of the company. You invest in the company and the expectation that they are going to make profits in the future, and you will win through dividends and higher stock prices. In the crypto market, the same idea just simply does not apply. Cryptocurrencies don't act like companies that have quarterly financial reports. It's just a different paradigm and different structure. Stock markets, very tightly regulated, and therefore they have a lot of safeguards to protect the consumer. By comparison, cryptocurrency market has very little regulation, and that makes it way more susceptible to classic manipulation techniques like pump and dump. That is what a lot of experiences turn out to be. So again, let the buyer beware. In our next episode, we are going to go into technical analysis, which basically is doing a charting based on history. Technical analysis bases almost solely on the fact that history repeats itself due to institutional order flow. It's an interesting kind of construct, and we're going to get into it, but we're not going to get into it today. So that's going to do it for this episode. Thanks for joining us. Like, share, and participate. Send your questions or comments to help@cryptosavvy.org. Check out our website at cryptosavvy.org for episode information, leave us a message, and visit our store. We sincerely appreciate your support in helping us bring you this podcast. You can find the CryptoSavvy podcast on Stitcher, Spotify, iTunes, Buzzsprout. Look for us wherever you get your podcast. So until next time, do your own research, apply critical thinking, and make smart choices. See ya.